Tesla delivered one of the most anticipated earnings reports of the season. Yet instead of celebrating the company's long-term vision, investors focused on something else entirely, and the stock sold off sharply. At first glance, the reaction seems surprising. Tesla continues to invest aggressively in artificial intelligence, autonomous driving, robotics, and energy, businesses that could define its next decade of growth. So why did Wall Street reject the stock? Was it because the quarter was weaker than expected? Or was the market reacting to something much bigger, the enormous cost of building Tesla's future? In this video, we'll look beyond the headline numbers and explore what investors may have missed, what risks they are pricing in, and why this earnings report could mark a pivotal moment in Tesla's long-term investment story. If we look beyond the stock price, Tesla's quarter wasn't simply a story of a weak business. The company continued to generate solid revenue, its energy segment remained an important growth driver, and management reaffirmed its long-term commitment to AI, Robotaxi, and Optimus. So why did investors react so negatively? Because this earnings report wasn't judged on revenue alone. Wall Street focused on earnings quality, shrinking margins, rising capital expenditures, and weakening free cash flow. In other words, investors weren't questioning Tesla's ambition, they were questioning how much that ambition will cost before it begins to generate meaningful returns. That's the real debate driving Tesla today. While Tesla reported several encouraging developments, Wall Street quickly focused on a different set of numbers. Earnings came in below expectations, automotive margins remained under pressure, and free cash flow weakened as capital spending accelerated. Those figures became the market's main takeaway. To many investors, this wasn't simply an earnings miss, it was a signal that Tesla's next phase of growth could require far more capital than previously expected. And when future investment rises faster than near-term profits, the market often becomes less patient. In just one trading session, the conversation shifted away from AI, Robotaxi, and long-term innovation to a much simpler question: how long will investors have to wait before these massive investments begin generating meaningful returns? The rising investment isn't happening by accident. Tesla is deliberately spending billions to build what Elon Musk believes will become the company's next growth platform. That strategy extends far beyond electric vehicles. It includes full self-driving, Robotaxi, Optimus, AI training infrastructure, and the massive computing power needed to develop increasingly capable AI models. Management believes these investments could create businesses that are significantly larger and more profitable than selling cars alone. The challenge is timing. Building an AI platform requires enormous capital today, while the financial benefits may not become visible for several years. And that's exactly where Wall Street and Tesla appear to disagree. To understand Tesla's strategy, we need to look beyond this quarter's financial results. Tesla isn't investing heavily just to launch another vehicle. It's building the infrastructure required to support an AI-driven ecosystem. That includes expanding AI training clusters, increasing computing capacity, developing autonomous driving technology, and scaling products like Robotaxi and Optimus. In many ways, this is similar to how major cloud companies spent billions building data centers years before AI became commercially valuable. Tesla believes today's capital spending is laying the foundation for tomorrow's competitive advantage. The question is whether those investments will eventually generate returns that justify the enormous cost. Building the future is one thing. Delivering measurable returns is another. That's where Wall Street is drawing the line. Investors aren't saying Tesla should stop investing in AI. They're asking a more practical question: when will these billions of dollars begin generating higher earnings, stronger cash flow, and better shareholder returns? For institutional investors, capital allocation matters just as much as innovation. Every dollar invested today is expected to create meaningful value tomorrow. Right now, Tesla is asking investors to be patient while it builds the foundation for its next generation of businesses. Whether that patience is rewarded will ultimately determine if this massive AI investment becomes one of Tesla's greatest successes, or one of its most expensive mistakes. This isn't the first time Tesla has faced skepticism for making bold, expensive decisions. Years ago, investors questioned the massive investments in gigafactories, battery production, and the global supercharger network. At the time, many believed the company was spending too much, too quickly, with uncertain returns. Yet several of those investments eventually became key competitive advantages and helped Tesla scale faster than most traditional automakers. Today's AI strategy follows a similar pattern, but with one important difference. The scale of investment is significantly larger, the technology is more complex, and the outcome is far less certain. History shows Tesla has overcome skepticism before. The question is whether this time will be another success, or a very different story. Of course, Tesla's strategy comes with significant risks. Autonomous driving still faces technical challenges and increasing regulatory scrutiny. Robotaxi must prove it can operate safely and scale commercially. Optimus remains in the early stages of development, while AI infrastructure requires enormous capital before generating meaningful returns. Competition is also intensifying. Traditional automakers, technology companies, and well-funded startups are all investing heavily in autonomous systems and artificial intelligence. In other words, Tesla's long-term vision is compelling, but execution is everything. The company isn't being judged on its ambition anymore. It's being judged on whether it can transform that ambition into sustainable profits and long-term shareholder value. Despite those risks, the potential opportunity remains enormous. If Tesla successfully commercializes autonomous driving, scales Robotaxi, expands its energy business, and eventually brings Optimus into real-world applications, the company's future could look very different from today. Instead of relying primarily on vehicle sales, Tesla could generate revenue from software, autonomous mobility services, AI-powered products, and energy infrastructure, creating multiple engines of long-term growth. That's why Tesla continues to invest aggressively despite the short-term pressure on earnings. Ultimately, the market isn't debating whether Tesla has ambition. The real debate is whether those ambitions can evolve into durable businesses that generate meaningful cash flow and justify today's extraordinary investment. The sharp sell-off after earnings highlights a familiar pattern in the market. Wall Street often rewards companies that deliver strong quarterly results and punishes those whose investments reduce near-term profitability. That's a rational response when investors are evaluating earnings over the next few quarters. Tesla, however, appears to be optimizing for a much longer timeline. Management is willing to accept weaker margins and heavier capital spending today if those investments create a stronger competitive position 5 or even 10 years from now. Whether that strategy succeeds remains uncertain. But one thing is clear. The biggest debate surrounding Tesla today isn't about electric vehicles anymore, it's about whether the company can turn massive AI investments into sustainable long-term value. Tesla's latest earnings didn't just trigger a sell-off. They reignited one of the biggest debates in the market. On one side, investors see declining profitability, weaker cash flow, and billions of dollars being spent before meaningful returns are visible. On the other, Tesla sees those same investments as the foundation for its next generation of growth, powered by AI, autonomous driving, robotics, and energy. Both perspectives have merit. The question is no longer whether Tesla can build great electric vehicles. It's whether the company can transform today's massive AI investments into durable businesses that create long-term shareholder value. That, more than this quarter's earnings, will determine whether Wall Street was right to reject Tesla's biggest bet, or whether history will eventually tell a different story. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.